Many investors look at two dividend giants, SCHD and FDVV, pull up their recent 1, 3, or 5-year returns, and immediately declare a winner. But picking a fund based solely on the last few years is a trap. If you build your portfolio by constantly jumping to whatever fund is hot right now, you guarantee that you are buying at the absolute peak and selling at the exact wrong time. Markets operate in cycles, constantly sloshing back and forth between different sectors and strategies. Right now, if we look at recent history, FDVV is crushing SCHD. Over the 1, 3, and 5-year windows, Fidelity's fund looks completely dominant. This chart shows why recent performance is misleading. On the left, FDVV pulls away over 5 years. But look right. Zooming out to a full 10 years, the total return of both funds meets at the exact same endpoint, roughly 197%. Over a decade, they deliver the exact same wealth accumulation. That means treating them like direct competitors fighting for the same job in your portfolio makes no sense. Comparing SCHD to FDVV is like comparing an apple tree to an orange tree. They both produce fruit, but they require different climates, different soil, and are engineered to yield entirely different results. To build a portfolio that actually survives over the long haul, we have to look under the hood. We need to understand the mechanics of why they perform differently under the same market conditions. Investors who ignore these underlying strategies are the ones who panic and sell everything the minute the broader economic weather changes. Pairing these funds covers specific vulnerabilities in an investment strategy that neither can handle alone. Once you stop trying to pick a winner and start defining the specific role each fund plays, you eliminate the constant wealth-destroying cycle of buying and selling. Let's strip away the top-line returns and look at the engine driving FDVV. We do that by examining its sector breakdown. This sector comparison matrix shows FDVV's heavy weighting in technology and financials, exposed to mega-cap growth companies like NVIDIA and Apple. Now look at SCHD on the right. Its largest allocations are packed into defensive, value-driven sectors: staples, healthcare, and energy. The trade-off is immediate. FDVV generates high capital appreciation when the tech sector is booming, but leaves the investor vulnerable to steep drops during tech corrections. These divergent strategies mean SCHD and FDVV only share 14% of the same stocks by weight. Holding one gives you exposure to risks that the other completely avoids. They are operating on entirely different risk profiles. Most people buy these funds for income, so we have to examine the actual dividend yields and, more importantly, how consistently that cash flow grows over time. This chart displays SCHD's primary strength. Look at this relentless, mathematical year-over-year increase in its dividend payout over the last decade. It steps up perfectly from 42 cents a share to $1.05.
But that consistency comes with a mandatory trade-off. To achieve that reliable growth, SCHD generally offers a lower starting yield compared to riskier, pure high-yield funds. Now we add FDVV's history to the chart. While its overall portfolio value grows faster, its actual dividend distribution is much less stable. During volatile years like 2020 and 2024, the payouts completely stagnated. If you need that cash to pay your bills right now, relying heavily on FDVV carries the risk of a frozen payout. For absolute reliability and cash flow, SCHD is the superior choice. A common oversight when holding FDVV is how it interacts with the broader index funds already in a portfolio. This is known as overlap risk. When you buy multiple ETFs, you can easily end up buying the exact same underlying companies twice without realizing it. This diagram reveals the hidden issue. If you hold FDVV alongside a standard S&P 500 index fund like VOO, you have a 41% overlap by weight, mostly concentrated in large tech companies. You might buy a dividend fund, confidently thinking you are diversifying your portfolio away from the S&P 500. But with FDVV, you are actually just doubling down on the same top-heavy tech stocks. Adding FDVV to a portfolio that is already anchored by the S&P 500 reduces your diversification. If the tech sector falters, your downside risk is amplified across both funds. To decide what goes into your portfolio today, we have to see how these strategies perform when the market turns entirely against you. We ran a simulation of a $100,000 investment over a 20-year timeline.
We isolated the bottom 10th percentile outcomes, a lost decade filled with market corrections and flat returns. This chart tracks the 10th percentile worst-case scenario. A purely FDVV portfolio drops to $185,000. SCHD's defensive weighting shines, surviving with a higher floor at $277,000. Splitting your investment 50-50 raises the floor to $193,000, while maintaining upside potential in healthy markets. Blending these two strategies acts as an insurance policy. It allows you to capture the high ceiling of tech growth while installing a concrete floor that prevents devastation during a prolonged crash. So, how do you actually apply this data to your own accounts? The decision comes down to your current holdings and your life stage. First, let's look at the younger investor who is purely in the accumulation phase and does not currently own a core S&P 500 index fund. Younger investors should prioritize FDVV, accepting higher volatility for maximum appreciation. Consider investors nearing retirement or holding a core S&P 500 position. This group should prioritize SCHD. Sacrificing peak tech growth buys critical diversification and mathematically reliable income. True wealth is rarely built by selling lagging funds to chase winners. It is built by identifying your specific vulnerabilities and designing a complementary portfolio that thrives across all market cycles.